Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today would typically be Michael Becker, but he's out doing some due diligence on another transaction. Good for Mike. So joining me today, of course, is James Eng. James, how are you?
Great. Thanks for having me.
Also with Old Capital. So in the podcast today, we have a friend of the family, a gentleman that I probably have known for 20 or 25 years in multifamily. I would say he's the old man of the sea, the guy that everybody kind of asks about, just like as a kid coming up to the grandfather. Grandpa, what was the war like?
What was it like?
So Scott Henderson is in the podcast, and he's going to give us a little bit of a perspective on the multifamily industry, not just for today, but just what it was like back in probably by the time that actually you started in the business.
Started in 82.
So he's going to give us a little bit of a history lesson, a little bit of perspective, just to kind of bring some clarification into these multifamily times and just making sure that everybody is pretty much on the same page. So we're going to really enjoy speaking with Scott a little bit about his background and just his perspective on the multifamily industry. So I'm going to kick it over to James, and let's keep it going.
Scott, thanks for coming in today.
Thank you.
Can you give us a little bit of background of sort of, all right, you started in 1982 and sort of walk us through to up to today and sort of what you're working on today?
Absolutely. Well, thank you. And thank you, Paul, for having me here today. It's an honor to fill in for Mike, who's traveling. So I'll put my second team quarterback on and come in and fill his shoes. But I did start in 82. I was fortunate enough in going to college up at North Texas to actually have enough hours to get my broker's license. At that time, you didn't have to have 2 years apprenticeship. So I became a real estate broker while I was still in school. And the irony of that is, and why I'm in multifamily, because the tax codes at that time were very favorable, if anybody remembers back that far, for investing in multifamily. So capital investments and dollars were all being underwritten for tax reasons, and multifamily was the darling at the time. So I studied multifamily as I had 1 foot in academia and 1 foot out, and working with local developers in Denton. I learned some lessons early that are still applicable today from what I learned back in 82. And then from there, I went with the Hank Dickerson Company, specialized in multifamily brokerage. And from there, I've been with large firms, small firms, independent firms. I'm currently with SVN on a national platform, and I specialize in multifamily brokerage and investments, primarily in a 4-county area of the Dallas, Tarrant, Denton, and Collin County markets of DFW. But I'm not limited, as I've brokered all over Texas, all over the country, where we're fortunate to be able to cross-pollinate with other brokers through Sperry Van Ness, through SVN. And so I've been in Oklahoma and Arkansas and Georgia, and seen those markets as well, and being able to compare those with DFW and the other major Texas markets.
So why don't you talk about maybe the first recession that you saw and sort of what you learned going through that?
Learned some valuable lessons, and the irony of that is I believe that some of the indices that we're seeing in today's supply and demand are a direct correlation to overbuilding that we experienced in the early 80s. And I'll explain that further. But when I graduated, we were coming in out of a recession, and the tax laws encouraged capital investment, whether the actual multifamily property made economic sense or not. And by the way, I'll throw a lender attribute in there. You combine that error in policy with a decontrolled savings and loan, and we had lenders making basically 110% financed deals on multifamily projects that economically didn't make sense, but the write-offs brought the capital in for shelter purposes.
110%?
We had 110% loans based on appraisals, And the properties never were able to satisfy. If you went back and looked at the subscription documents of a syndication at that time, you saw negative cash flow for about the first 5 years, usually during the subscription period of paying in for the equity contribution. And then you had a break even at the 6th year, and then you had positive from that point on. And the irony of that was about 1988, I found an old subscription documentation that merited that, and the indices actually went the opposite direction. We had not only did we not break even, we had lower rents, higher expenses, and more foreclosures. And that brought in, of course, everybody into, I guess they've read about it in their middle school textbooks, was the RTC. That was a whole next generation of survival from that. But the disciplines we learned there was that, we built 58,000 units in 1985. And, I saw an article recently, we have 50 here now. And the irony of it is that those 58,000 units in 1985, from far west Fort Worth to far east Dallas, all had about 50, 55 cent rents. They were all the Class B, I say Class B, the 1980 vintage garden style that you see today that's so popular. But we have come through basically an oversupply that has kept affordable housing so cheap for nearly 25 years. And so now we're seeing the fruits of that now, as we've got such commodity housing that can't be replicated at the cost. So very interesting study if you were to follow the oversupply of those 80s and how that affected the various cycles we've been in, especially the two, or actually three, real estate crashes that I've been a part of, starting in the early 80s, and then, of course, the 90s, and then, of course, our recent one after 2008.
Do you happen to know absorption on those 58 units that you said you built in 1985?
You're going to love this story.
Yeah.
Everybody knew me as a real estate broker. And so those days, you didn't have documentation that you could go online and get and subscribe to. You had to go old school and go out and talk to the manager. Wait, what's your occupancy? What's your rents? And they knew I was brokering apartments, and I'd go into these offices, and they were all 95, 100% occupied. And they would tell me this, and this is what we're getting in rents. And as I drove out, there'd be a banner on the side, 5 months free on a 6-month lease, so so I knew something was wrong. And I had an investor out of Wichita, Kansas. I asked him one time, what's the first thing you look for in a submarket that you're interested in investing in? And at that time, locators were a very popular way of finding an apartment. And he said, I befriend a locator. And so ironically enough, I created my own locator company, not to locate, but when I call an apartment building as Convenient Locators of Louisville, the manager would be glad to tell me of how many units they had vacant and what specials they have and how much they'd pay a locator to send a tenant over there. So that shows you how the times have changed. I had a shell company so I could get accurate information on the marketplace. So when you say absorption, that was street level information and not posted information.
So when we compare that time versus now, 30,000, I think, are coming online this year in terms of DFW new construction. Probably 20 to 25,000 will be absorbed, if not more.
Yeah, the pace. And by the way, this is an interesting topic, because of that 30,000, tell me real quick, and you can answer this, where is that 30,000 located and who are they targeting? What would you say? Would you say 95% of that's in the core interurban market, and 5% in the suburban area?
Probably not that much, probably 80% in sort of uptown Plano Frisco area, targeted at, $1.50 to $2 in rents. Sure. Targeted at millennials working at Toyota or Liberty Mutual, JP Morgan, those type of companies.
And you brought up millennials.
Yep. And so, 20 to 35.
Okay. Millennials, of course, are a great target market. We're also learning that many of these units, the millennials are doubling and tripling up to make those rents. And I know this topic's going to lend its way to where do you see telltales of a possible recession. And one of the recession points that I think will be a telltale is when a group of 4 are living in a 2-bedroom unit and 2 of them have to go home and live back with their parents. You have an owner of an apartment complex now that has to find 4 renters for 1 unit. And so you're going to start finding that if the millenniums who are doubling up the day they want to move to another location or move home, or their contract or their salary is coming to an end and they're not going to renew the contract, how deep is that renter base for the $1.50, $2.50, $2 a foot properties that are out there? So we see a possible correction there. It hasn't happened yet, and there's still good momentum. There's a lot of people moving into the area. Again, fundamentally, there's enough support, but just watch the telltale signs of that.
So as an investor, if you only get a rent roll and a T12 and you're expected to make an offer, how can you see how many people are renting one unit?
Very interesting. I also like to look at the utilities. If they are monitoring the utilities, they'll tell you how many people. We had a little street smart technique that we did back in the day when I'd get a rent roll, and they'd say, well, we're 70% occupied, but the utilities would look like they're 100% occupied. So if you drove the property at 2 a.m, you'd find every parking space full. So usually you'd have some tenants paying cash and not recorded on the rent roll. So little things, little techniques we learned from the street. But to answer your question, as far as the momentum of these supply meeting demand, remember, we're building complexes now that are more renter by choice, not necessity. And if I got to be careful with this, but I think that's a fad, and fads can change. I remember when West End, they took the risk to build the West End. It was very popular. And then, of course, when Deep Ellum came along just a few blocks away, West End took it on the chin. So faddish real estate can change prevailing winds. So right now it's very popular to be in Uptown and Central Business District and the lifestyle and such. But if that fad changes, then if they move to the out, then you've got overbuilt situation. And many people feel like we may be, I don't want to call it the next ghettos, but the units you're seeing a high concentration in some of these areas, with the rents and the absorption trends, if they decline, occupancy goes down, could we have a serious situation on our hands?
So do you feel better about suburban, sort of Class B? You want to talk about B and C suburban assets?
I feel better about fundamentals. I like suburban properties because ultimately everybody goes to suburbs for schools, for the lifestyle. And that's why lifestyles in the Central Business District are popular right now. But once people get married, maybe have children, schools become a driving issue. And by the way, I think out of all the development we have, we're actually underdeveloped in some of the suburban markets. And I'm not really speaking of Frisco and certain areas of Plano, but there are other communities in the Metroplex that are dying for multifamily development to accommodate that demand that's out there. But capital and financing is forcing developers to consider interurban core. I had I won't mention the names, but I had a very strong Class A developer tell me that it's not like the old days where we found a location that we liked and supported. I got to go where the capital tells me to go. So I think that's a telltale sign too.
So banks are restricting developers on their location based off of where they see the future, or where
I would change the word to they're encouraging instead of restricting.
Sure.
They're encouraging the developer to consider an interurban development versus suburban area.
What are you seeing? I mean, I know you spend a lot of time here in Dallas, but outside of Dallas, outside of where we live, I mean, Houston definitely is a different market completely. Mm-hmm. What are you seeing outside of Dallas in terms of fundamentals?
Paul and I were talking about this not long ago. One of the things that I'm seeing is that you don't have to go very far for fundamentals. And I don't have any real magic at this. National Multi-Housing has given the average commuting time of about 40 minutes, 19 to 20 miles. I drew a circle around the major metros and made that circle represent about a 45-minute drive. And then I watched where the spoke of growth is, what directions. And of course, we all know 75 and Toll Road. And I went up 45 minutes from there. And of course, we invested. I bought in apartment complexes in some secondary markets like Bonham. We'll look at Sherman, Paris. We see where growth is going. But at the same time, you can go into those markets and find fundamentals. And the residents there really are locked into those markets, because if they want to move to McKinney, they'll pay $500, $600, $700 more a month than maybe in our complexes. So, and you mentioned Houston. I'm active in secondary markets down there like Tomball, and we're experiencing the growth of the Woodlands. So if you draw your spoke and see northwest Houston growth and the growth from the Woodlands, Tomball got sandwiched, in there. So we're the beneficiaries of that kind of growth. So I found that if you'll step out a little bit from the major markets and be within a 45-minute drive, you might be able to find some better fundamentals, and that could be changing. That may change, as we speak.
So how much of a premium on cap rate are you seeing in secondary markets for that type of transaction? Or is there just less risk on rents?
It's actually because of the secondary location, there's more risk, so our cap rates are better. Risk becomes a direct correlation to yield and cap rates. And we were a little spoiled on this. We got double-digit cap. So when you have a double-digit cap, all the other indices, debt coverage, falls into play. Price per unit, price per foot was very attractive. My gross rent multipliers, all the indices that we use, fell into play. That might be an exception to the norm, but our cap rate swings are noticeable when compared to major metros. If you go into the secondary markets, we see a little bit of a spread on those.
So you're seeing more investors go into secondary markets now, or are the people staying away on it?
I think you're seeing more, but it's still a step outside. A lot of times the capital's going to go where they feel comfortable. A Dallas complex has a better capital raise possibility than a Paris, Texas, or a Honey Grove or something out in those locations. But the contrarians that are stepping out are finding that the yields are meriting those capital raises and bringing the risk into play when they really realize, then what I found out, we really have a monopoly up there. And once you have a kind of a supply demand where there's no more new supply and there is growth in the area, that's the variables that we like to use to say that there's less risk, actually, in our opinion.
What's the hardest part about buying in secondary markets?
I will always say personnel. I don't manage these properties. And by the way, I think that's a fundamental for everybody and possibly a mistake or an error that's being made right now with the euphoria that we're in. But management is a critical component of this business. So you have to have personnel that want to be in a secondary market. And actually, there's a good chance that there's somebody that wants to live or they live in that area already and want to stay. And if they can be trained and think like an owner and maybe even have a piece of the deal to encourage them, we find that the properties work and run very well up there.
How did secondary markets respond sort of in 2008, 2009?
I think they had to compete, and this may be the Achilles heel of the secondary market, but we had to compete with the primary markets being a great place to come in and buy. Again, though, in 2008 was we saw the winds of the recession building and had to come out of a fallen market. And when we had renters available for those major markets, the secondary markets, either you had to work in that market or you moved, you had availability of supply. Right now, because of the economic barrier to entry, secondary markets are appealing because there's really nowhere to move into a major market. And, we'd like to say McKinney and Frisco and Allen, and those are all major markets now, and they weren't back then. McKinney might have been even a smaller market, but as you see these secondary markets expand into major, it's from a rental standpoint, it's more economical to be in a secondary market. I will say this, one of the phenomena I learned about secondary markets, unfortunately, is you can have an occupied property, but they will move at a $10 a month rental increase. They don't mind driving to Tyler or Longview, but that's changed now. We see more people quite content with their rental rate, and we're able to raise our rents and keep it under the coattails of the surrounding market and keep our property full.
No, I mean, near our office, there was an article in the Dallas Morning News about how they're opening all these new restaurants in Plano and Frisco, but there's no waiters because nobody can afford to live in Plano or Frisco. They're having to drive 30 minutes, and we were eating at a restaurant. The manager was talking about how that was the most difficult part of personnel because you're paying someone $10 an hour, but they were given bonuses of $1,000 just to get waiters and waitresses to come in.
And by the way, again, we're throwing out some pieces to a puzzle that point us to where's the next recession coming. And we're watching salaries and wages. How many more years are we going to be able to hit people with $150 a month, rental increases? And that's something that's concerning me right now. By the time these people have gotten their latest rental increase, and they pay their car payment and put shoes on their kids and maybe a six-pack of beer, they're out of money.
Grandpa Scott, tell me about the last big war you were in.
You're asking me to do a barefoot in the snow story, walk 15 miles to a real estate deal?
A lot of people who haven't been in multifamily, haven't been in financing, haven't even been alive since 1985 or so. Kind of talk a little bit about, this is Dallas or Texas was the kind of the epicenter for the savings and loan crisis. And talk to me a little bit about what you remember in 1985 versus 1986 and 87, because that's probably the first recession of apartments that I went through.
Right.
And your perspective a little bit about that, what caused it, and tell me a story or two, what went on here in Dallas.
Great stories. And these are times that are long behind us. And by the way, let me just fast forward to where we are now. I think a lot of the rules you see, for example, with Fannie Mae, some of the policies you see with Freddie and Fannie were all directly related to some of the sins of the past. Cross-collateralization was a big one. Things like that were all byproducts of what happened in the early 80s. But I'll never forget the day I was at a RESI, Real Estate Syndication Group, lunch meeting. It was 1986 when that came down. And the panel actually stopped during the lunch and just said, you know what? We really have nothing to say because we don't know what's going to happen. The way we do business that we know it has changed. And that was the end of syndication at that point. Now, ironically enough, we saw syndication come back in the form of tax credits. I won't mention his name, but a CPA came into the market and said this will be the last true syndication, dollar for dollar tax credit. And he couldn't sell anybody because syndication had such a bad name. And now, look what you have to do to get a tax credit deal done. It's so specialized.
So again, you talked a little bit about the number of units that were being built in 1984, 85, and the tax laws changed in 86. Mm-hmm. And then did everybody go to the beach?
Well, all the renters were at the beach anyway. You got to remember, at that point, you had an inverted supply to demand, and these properties were never built economically. They all of a sudden, overnight, had to be valued at to support economics.
Yeah,
that's why
to the market.
Right. That's why you started seeing many properties in the 8,000 to 10,000 a unit range. That gives you an idea how far rents were below to support value. So we had a lot of that issue to deal with and correction.
And how many syndicators actually went out of business during that period?
I would have to say nearly all. I know some that have survived that followed some fundamentals of underwriting and didn't buy into. I'll tell you something else that should be used today, even with what I'm saying and what I call Tupperware syndication, is that.
And why do you call it Tupperware syndication?
I think a lot of what I'm seeing in the market, and I call it Tupperware brokerage and Tupperware syndication, is that a lot of disciplines are not being used.
Pursued.
We're selling the general public on a euphoria right now, and none of them have experienced trench warfare of a very line item competitive industry. And I thought about this too. It appears when you look at cap rates, and by the way, I'm probably a contrarian. I put least emphasis on cap rate. Unfortunately, it is the standard of measurement of value, so I tolerate it, but I see a lot of error above the line to get to a cap rate that if you let the cap rate be your only rudder for your investment ship, it gives you a margin of error that unfortunately can have exponential losses in the future. So cap rate should be a part of it, but there really ought to be about 4 or 5 other indices. But back in that day, when the values of the loans, when the actual value of the property fell 30 or 40%, remember we had 110% loans. So
yeah.
That's why RTC was brought in. The loss was just so great that they had to come up with some method to move this product out. And all the syndicators were gone because the syndication packages, there was no incentive. There was no economic benefit. It was all tax driven.
Right. These properties were taken back by the savings loans. That's why a lot of the savings loans went bad, went to the FSLIC, then FDIC, then RTC.
Yeah, you had the
OTS.
Southwest Plan, and then
Southwest
all of a
Plan.
sudden, the RTC.
Right.
Mm-hmm.
So a lot of people just don't remember that.
Oh, no.
They weren't in the
Right.
business that these properties were taken back because the economics just didn't work. And,
Right.
and I remember actually some buildings, because they had so much inventory, had to be
Shuttered and mowed down. If you go out, matter of fact, if you drive out to very hot I-30 now, and
Yeah.
right out where properties are just doing great, you'll still see slabs in the ground where development was just, it's cheaper to mow the building off the slab than to try to keep a security fence around it.
Yeah, then the RTC came in and then they kind of fire sailed a lot of these properties, and that's why we picked up a lot of LURAs at that period of time, where land use restriction agreements were put in for affordable housing on the property, and those have been in play for 30 years.
Right.
On those, there's different numbers, whether it's 40% or 60% of the median income that you can only have tenants be at that maximum as tenants. It's not Section 8. It's just that it has to be affordable housing, and that's where, when the properties were grabbed back in the savings and loan process, that's where the LURAs went into effect. So we're still seeing some effect on some of these older properties that were built in the 70s or 80s, and then they were turned over to the RTC.
You're exactly right. You see the policies that the RTC inherited these, they incorporated that into a way of getting affordable housing back out into the market. And so I can see somebody entering our market now wondering, what in the world is this? You have to go back into your history books to determine if that's survived that length of time.
And so really in 1986, the tax law change was an immediate effect on what happened with valuations on properties and the impact that it had on investors.
Mm-hmm.
That was kind of a one-time event. Let's kind of walk through, like, from 91, 92, 93. When's the next kind of recession? What type of a pullback did you see?
Well, in the 90s, of course, we had the dot-com issues come up, and we did have a little bit of a benefit. I was able to sell complexes to people that were taking their paper.com and putting it into hard assets. Some people that were going to step out ahead of the cycle and saw that coming converted their paper assets to hard assets and multifamily. So we did well, but it was very difficult times because that affected financing all across the nation. And really only until the RTC made it a policy that they would provide financing, we still had a problem, because for a period of time there, I'm going to say 2 or 3 years, they wanted nothing but cash. And there really wasn't any lenders out there to make loans at those prices. So the discounts was even greater to underwrite, because you keep coming back to economics. So until the RTC decided to underwrite and say, if you'll bring 20, 30% down, we'll provide financing, that we had RTC actually open up and provide some financing.
And that's what's something that a lot of people ask, well, what happened in 85, 86? Well, the tax change was a big thing, but for financing, it kind of shut down.
It was over.
And so new construction from 87 to probably into 96 or so, 97, was not really available because there was so much inventory that was still in the marketplace at that period of time. A lot of lenders did not want to take the risk because they'd already been burned.
That's right.
And a lot of bankers have long-term memories, just like elephants, of what happened during that period of time. So they weren't lending on brand new construction. So there's a kind of a donut in the multifamily business.
And by the way, interesting you bring that up. We were talking the other day with another salt of the sea, somebody that's been around a long time. And we even noticed that there was a gap in just talent in this industry, from brokerage to lending. Everybody coming through college and graduating was not coming into the multifamily or coming into the real estate business. They were taking other. So there's gaps in just handing the ball off to the next generation. We have a generation gap, which I think is also what I'm seeing today as a problem. But it's interesting, if I can jump between recessions, you notice that the policy forced real estate investors to put their capital into real estate, but based it on another value. That in the 80s was tax, your personal tax write-off. Well, what did we do with the CMBS market? We took the value off of real estate and put it where? Secondary, onto some other instrument. And what has happened when you take the value out of that and move it to something else, to security? You take a discipline out of the multifamily in our particular, but it's all disciplines that had CMBS loans. But that's a policy problem in that you underwrite the asset on another security versus the actual asset.
Yeah, just in the matter of time, let's skip to the 90s, actually start in the 2000s. In 2003, 2004, 2005, what Scott is talking about is that there was subprime single-family lending, and there was subprime multifamily lending at that period of time. So that's where we should never have given loans to people that didn't have jobs, didn't have credit, didn't have any income or down payment on the things. It was very similar to that on the multifamily side, where we were underwriting deals to pro formas and pushing up rents and didn't underwrite towards taxes or insurance, or not boosting or bringing up the taxes to what it would change to when the next buyer group were to do it. And we did a lot of interest only on these transactions. So those transactions were not underwritten for, if the bankers really were bankers in the deal, it was underwritten to the market, to what yield was to be expected on bonds, whether it was here in the United States or overseas. So if bankers really had made the loans in the properties, if bankers had really made the loans in the single-family subprime market, they would never have done it.
That's right. Yeah, as a matter of fact, we shifted our values. And when we do that, what do we also shift out of? Discipline, underwriting discipline. Doesn't have to underwrite. It's secured somewhere else. So we lose our underwriting discipline, and then that comes back to get us. And so a whole industry will go through a correction cycle, and that correction is very painful, to exist. But it's needed. Corrections are needed. That's what makes real estate cycles and opportunities too. So.
Yeah. So on multifamily in say 2017, talk a little bit about disciplines. I mean, talk a little bit about how you view deals, and you're old school. And old school is sometimes good school. And between the gray hair that you have in your head and the lack of gray hair that I have on my head,
aging rapidly. Yeah.
Talk a little bit about doing it the right way.
Right.
So give me your perspective.
Well, it can be very frustrating. And I've gone to many of your conferences and talked to numerous people, and they're very frustrated because the brackish waters of their underwriting is meeting with the reality in the market right now. And so everybody says we can't find product or supply. And unfortunately, the answer to that is yes, you can at a price. Mm-hmm. Yeah, if you can find it. Real estate's a very liquid business. That's a contrarian comment, but it's all a function of price. So it's just a price I don't want to pay, and there's the gap that you have. So what ends up happening is I'm going to throw a word out, and I think it's, if you had a sale, I love to sell. I think a telltale on a sale and where we could be is when you start seeing speculation, any kind of speculation. I think that's the first breakdown of our discipline. When we start assuming future revenue and we're going to make a loan based on future events, it may happen, but I've just seen more than enough evidence of time that when that speculation becomes market, when we start making appraisals based on those speculations, then that becomes standard in the market, just like in the 80s when, this doesn't going to have cash flow for 5 years. We just looked at that and said, that's the market. We blamed it and said, or supported it by saying that's the market. When that's a discipline, what do you mean you don't have cash flow? Then don't buy it. Don't make a loan on it or correct the price. But no, that was the market. Well, why is it the market? Well, I can get 4-to-1 write-off. So I'm going to trade a non-performing deal for a 4-to-1 write-off on my taxes. And really the sad note to note on that, if I can flash back to that, the very reason that people invested in that to avoid paying taxes when they had their phantom income notice come in because their deal went upside down and foreclosed, those taxes came due. Mm-hmm. And by the way, they didn't have any equity because all their equity went into the tax syndication program. So that went away. So it was very painful. So I'd be very careful. I would not take anything that maybe the government puts out or a sponsor puts out that takes the value off the disciplines for the business. So if you underwrite with discipline, you manage with discipline. I was talking to one of my investors yesterday. We've been on this big portfolio that we're talking about. And we just said, when you do it fundamentally correct, you can, go through a recession. It might be painful, but you will survive a recession if you apply fundamentals, now. And so do not sacrifice fundamentals just because you need to get a deal. And that brings me to what I think is going on right now. A lot of sponsors, so much capital trying to buy a deal that they'll buy a deal at any rate, buy into speculation, buy into pro formas, and take reality off the table just to be having a deal. And I think that's a sign of the times.
Can you talk about in the 80s, the big incentive was taxes, but then in today's market, talk about interest rates, where they are today versus back then, and why people are so competitive on real estate right now in order to get a yield.
When you were in middle school, did you read about the SNL crisis? Because that is actually a great point. Paul, do you remember what interest rates were back? They were double digits. We were 12, 14. I remember when I bought I didn't have two nickels together, so that shows you why, I wasn't qualified to get a mortgage, and I got a deal. Mm-hmm. But I bought my first property, and I was so grateful to have a 12% interest rate loan because everything was 14.
Yeah, 12 to 16% was normal home loan rates. The prime rate was at 21%, and 81 or so.
So you see the government had to step in and say, well, with those interest rates, the cost to build played a role. And so let's give the investor a 4-to-1 write-off for multifamily to get construction, get those industries, the lumber, the wiring, the trades, all those people working. It was an incentive to get the economy back up. An apartment complex would have so many multiple trades benefiting from its development that it would go in and then it would, permeate throughout the economy and the economy would rise. We just never turned off the faucet. It kept rising and then it became market. And then once it became market, you can't turn it off because it's a painful correction until it finally crashes. And if you look at the mortgage-backed security industry and the syndication days of the 80s are very similar, just apples and oranges in product, but the underlying current was the same situation. They took it off the discipline and it became market. So if you were a disciplined investor, you weren't in the market. I had that say, well, cash flow? No, I'm sorry, you're not a buyer. You got to buy negative cash flow and syndicate the negative cash flow.
And how about, say, 2010, 2011, when they came out of the Great Recession, who were the ones that were able to keep their properties?
The ones I saw that kept their properties were the ones that maintained a fundamental sound operation, a day-to-day management. And I'll tell you, a unique phenomena came out of that. We never looked at the line item components that now we see on the revenue side. Back in about 2010, we started seeing, okay, we've got a property that's physically occupied around 98, but economic occupancy 75, okay? And we said, well, what's causing that? Well, you see they're signing 12-month leases, and to get those 12-month leases are certain concessions. So we started seeing a loss to lease category come in, and we started seeing wonderful opportunities at contracting to buy a property that had a large loss to lease but was physically occupied when the neighborhood was occupied, because we knew those were going to burn off and turn. And that's a component inside. I didn't have to go out and speculate and say, well, I'm going to go raise my rent $200 because I put in new carpet, paint, and appliances.
They were already signing.
They were already in. And if I'd go to them and say, how about a new ceiling fan and microwave, and we'll paint your cabinets, but we're going to go up $50 or $60. Well, I'm turning internally, and that loss to lease component would start narrowing, which made effective rent closer to actual gross. And that made a huge bottom line for the investment. So versus going out in the day where you were physically occupied at 70%, and you were going to go out and put $3,000 to $4,000, $5,000 a unit to renovate and lease up, you're speculating that market's going to respond by finding properties that were already occupied and being able to engineer within the operating statement. We were able to see what I think investors did very well in capturing yields. They'd buy at and I guess back then, we were starting to be shocked at 7 caps and 8 caps. But you can imagine when you increase an economic occupancy from 72 to 85, theoretically what that cap, did to value. And so they did very well, from that.
How did people in that 2007, 2008, those people who hung on through the recession and are coming out the other side, anything else besides management that you saw in terms of maybe the debt they used or any other tactics that they had?
Right. And the good point was debt. When we started seeing debt coming in at lower rates, we were able to take a debt burden off the table. And so that always helped too by bringing in that. Another thing that really kind of is something on a national perspective, we are even today considered cheap real estate by people in other areas of the country. I was talking to a large syndicator out of the 90s, and they held on to their properties just because value, price per pound, they bought right, but they didn't get worried about value changes because they were already so cheap compared to their other assets. So it's a perception in the market for a lot of people what value is, And their comment was, price per pound, we're happy at any level at this price. So they came through, pretty well.
I mean, that's one of the things that I think we talk about when we come out of the recession. We got to hold on to these properties during the recession like they're life preservers, because we know the value is going to be actually higher than they were.
That's right.
On the front side of the deal.
If your fundamentals are right.
If your fundamentals are correct and you're able to hold on to the property and get long-term debt. And that's the biggest, I think, we pound the table on really is, whether it's 10 or 12-year Fannie Mae long-term debt. I mean, that definitely is one of the reasons why a lot of these groups survived, that they didn't have a bullet coming on the back of their head for a hard maturity if the banks had shut down. I mean, that's a little bit of the craziness, in multifamilies. If the music stops, whether lending stops, and we saw a little bit of that back in November, December when interest rates went up so quickly, is that that was a little bit of a shock to the system where dollars were cut on loans because interest rates kind of a teeter-totter. Higher the interest rate goes, you still have that 125 debt coverage, the lower the loan amount is going to be. So that was a little bit of
it was a speed bump. It got our attention.
It did get our attention. So, my question really, saying all these things that we talked about a little bit, fundamentally, a thumbs up on going forward, everything still looks good, or, we're underwriting these deals a little bit, a lot tougher than we were in 85, 86 or 2000 or 2005 or 2008. I mean, we underwrite these deals solid. And I will tell you that with Fannie Mae or Freddie Mac, the underwriting right now is, and it was back in 2007, 2008, the delinquency was close to zero on multifamily stuff. What are you seeing right now? Are you still thumbs up and move forward?
And by the way, I want to take my hat off to the lending community, because unlike the previous crashes economy in the past where they were either a direct or a major indirect component, we were talking about the disciplines that Fannie and Freddie and that you have to measure now. And there are just some, you'll go to the fence and not go over it. And I think as long as the lenders apply their discipline, it's going to force investors to apply discipline. And in our case, we were talking about they're having to come with more money. We are not going to break our loan to value and our debt coverage ratios to accommodate your speculative underwriting. We're going to underwrite to this number. If you like it and you think it's what it is, you'll bring more capital to the table. The interesting thing is when you bring 30 and 40, even 50%, there isn't much yield left on the leverage that you were seeking. And so I'm wondering at that point, does the investors pull back and say, we're not buying? We're not buying. All of a sudden sellers say, well, where's all my phone? Where's all my people that are buying? I get 100 offers a day, that phone stops ringing. And when it stops ringing, somebody steps across the line and says, I'll take that price. And the price comes down a little bit to a number that works. So we may have some jousting back and forth, but it's going to take something like that. You're going to have to end up in what I call a nobody's market to get somebody to make that move. You're in a nobody's market. Does the investor step up and add another 10% to get the deal? Or does he step back and let the seller come to him? Unfortunately for brokers like me, I call that we're a commission only a part. And so that's when I know where we are in a cycle. When we're in a commission only a part, I try to get 3 meals a day built into a contract as a commission.
That's good.
But in Dallas right now, you're seeing it's still a seller's market in
very much
in multifamily.
I think it's the tail. You're seeing still the euphoria of a seller's market, but you're starting to see some speed bumps in that, and those speed bumps will grow, I think. And then you're going to find submarkets that are going to be probably the first to say, well, we need to move out of this submarket, and you're going to find then submarkets changing. And will Plano ever change for the next, in my lifetime, with as many people moving in? No, but there are going to be other pockets that are going to offer, opportunities and maybe allow some fundamentals that, you practice to invest in.
Any core beliefs that somebody who's entering real estate these days should know from the wise old one?
I'm going to tell y'all something that you're going to find great humor in. And by the way, I may come across pessimistic. I am not. I'm the most optimistic broker you can have. I'm just a realist. I apply probability. There's no guarantees, so I try to work the highest probability. But about 3 years ago, some people said, we want to talk to you about investment property, multifamily. And I said, okay, let's talk. And we sat down, and they kept calling it an investment property. And I said, let's really look. Let me take some counseling for you. I said, let's think about this for a second. You've got generally 24 units to the acre, and you stack buildings on top of each other in a condensed area, and you put humans in those buildings. And you mix humans with dogs and cats, and you bring boats, and you bring jet skis, and you bring motorcycles and cars and trucks and trailers. And unfortunately, you bring alcohol and you bring drugs and other social issues. And you stack all those together in a 19 acres at 24 units to the acre. And you get to manage that. You call that investment property? Why would anybody call that an investment? You don't sleep at night, So the problem is, I real critical, I go back to management. Somebody's got to run it. And I think one of the mistakes today is we're being told that multifamily is not risky. Multifamily is very risky. It's probably out of the disciplines, it's second only to the hospitality industry, because hospitality industry can be 100% occupied one night and zero the next. Mm-hmm. We've just been, I don't want to say lured, the market has, in this euphoria, brought, if you can fog a mirror, you can lease a unit. But I'm afraid that the day that these units become competitive, a lot of sins that are being masked by management because of the euphoria are going to show up. And now you've got to deal with rental drops while at the same time your taxes are going up, your utilities are going up. The Tammy Woods over at Tarrant County Appraisal District doesn't care what you paid for it as far as what's happening to the revenue. Mm-hmm. The taxing authority is a huge component right now in our industry. And anything threatening the NOI threatens the golden cap rate rule and threatens the debt coverage, threatens our ability to get debt, and thus reverses back around to the values. So it can teeter pretty quickly. And right now we've been lured into an assumption that it's just going to go on and on and on. And that's my belief, that I just don't know if we can hit these people with the rental rates that we're hitting them and continue that.
Maybe you can wrap up with, I know we touched on this, you mentioned you had 3 or 4 fundamentals that investors need to abide by, maybe.
Indices?
Yeah.
Very quickly, yes. If you hedge only on your cap rate, I think you're opening yourself up to a major area. And the indices that I use will all cross over a little bit. But I believe you look now at replacement cost, price per pound, price per foot, price per unit. These are commodities, and anytime you can purchase a commodity well below replacement value, you've got implied value. Okay, not necessarily. You still got to run it in the rents, but if the price per unit, price per foot are so far below in a commodity value, and it matches with a cap rate, with a gross rent multiplier, as the other indices, then I think you've applied 4 or 5 disciplines. But I've added now debt coverage ratio. Mm-hmm. I think cap rate is the downstream from revenue and expenses, but your debt coverage is even further downstream from cap rate. And so obviously if you have a strong cap rate, your debt coverage ratio, all things considered with interest rates and such, should be fine. But if interest rates move a little bit, that debt coverage changes. And how quickly can any yield that you're making be eroded with a change in the debt coverage? It can go quick. And so I've added debt coverage as my discipline too. And for example, in some of my secondary locations, my debt coverage was as high as 1.5. So I feel like there's a sleep factor when you have a debt coverage higher than the normal 1.2, 1.25 that a lender is pushing. So I build a sleep factor. And so I can make some mistakes and still be within a reasonable, yield and return for my risk for going into secondary markets. So that might help a little bit.
Any rule of thumb on replacement costs? Sometimes that's difficult. What would you say? How would someone apply that today in Dallas?
And by the way, I never used that in the 80s or 90s because you wouldn't replace these. And by the way, I'd never used gross rent multiplier. That was a West Coast measurement that came into play. But now with our rents going where they are, it's not a bad measurement to measure in, not the sole measurement, but a combination, of measurement. I sit in on Mark Humphrey's presentations, and he's saying that the Class A basic garden varieties in the 125 to 130,000 a unit, type. So if you're in a location where you're a B product in an A location and you can buy well below that, and you've got nothing but A's ahead of you, which, by the way, is another principle. Be a B in an A location or a C in an A location. Mm-hmm. You can always ride the coattails of the market, your neighbors. Another rule of thumb, and I'll leave with this if you'd like, but I believe zoning has caused more issues than good. We've zoned ourselves into little ghettos by concentrating 18 and 20,000 units on top of each other. If you can find a complex that is not neighbored by another multifamily property or even neighbored by anything that would impact its operations negatively, that's an attribute that's not a science, it's more of an art. But I like that because at least then no one's dictating what I can do to my asset. Unfortunately, I know people that have bought in the belly of the beast in some of our markets, surrounded by 14 properties that aren't running their properties by the books, and they try and they can't. They're exposed to the...
You got to buy them all.
You got to buy them all. You got to be the 800-pound gorilla, so that will solve that. And I know Paul is ready to finance all those 800-pound gorillas out there if they apply fundamentals, right?
Absolutely. The takeaway is apply the fundamentals, listen to some of the things that the old wise one...
Still in business, hanging in there.
That's good. So we definitely appreciate Scott Henderson. That was Scott Henderson here in the Dallas-Fort Worth area. Scott, if someone wanted to get a hold of you, what's the best way for somebody to get a hold of you?
Absolutely. 24/7 cell phone, 214-808-4359. You can certainly email me at scott.henderson@svn.com.
The old man of multifamily.
Thank you. A stalactite in the business.
So, James, what's coming up on October 5th?
I think two things. Yeah. Number one, the conference we're hosting Thursday, October 5th, 10 a.m. to 7. If you go to oldcapitalpodcast.com, you'll see a button there to register. And then if you haven't gotten our 15-page white paper on apartment financing, you can request it there.
Some great information. Scott Henderson, thanks for joining me today, and thanks for hanging out, James Eng. I'm Paul Peebles. Have a great day.
Thank you.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.